In the last 200 years, financial crashes have reshaped economies and lives. Imagine waking up as your entire life's savings vanish overnight. Shocking, right? Let's dive into 3 pivotal moments that left a permanent mark on financial history. Let's start with the Panic of 1873. Picture a boom in railroad expansions, banks lending freely, and the stock market soaring. Suddenly, a major investment firm collapsed, triggering a domino effect. Within days, banks closed, people panicked, and the Long Depression began. Fast forward to 1929, the Roaring Twenties, marked by thriving stock markets and mass consumerism. But on a chilling day in October, stocks plunged. Known as Black Tuesday, it wiped out billions of dollars and began the Great Depression. Families lost everything. It changed how we viewed banks and government roles forever. And then, 2008 brought chaos again. Housing market speculation had soared, powered by risky financial products. When it all came crashing down, global banking giants were on the brink of collapse. Recession swept across the globe, leading to massive reforms in financial regulations. These crashes aren't mere history. They teach lessons about human behavior, risk, and resilience. Keep watching to unravel how these events spotlight the fragility of financial systems. Let's take a closer look at the 2008 financial crisis. At its core were subprime mortgages, home loans given to borrowers with shaky credit. Banks bundled these loans into securities, selling them as lucrative investments. But as housing prices plateaued, homeowners defaulted en masse, revealing the house of cards it truly was. The result? A staggering $8 trillion in losses from U.S. stock markets between 2007 and 2009. But why did this happen? A toxic cocktail of greed, inadequate regulation, and lack of transparency. Financial institutions believed that housing prices would always rise, a dangerous assumption that fueled reckless lending. Credit rating agencies failed to adequately assess the risk in mortgage-backed securities, giving false security to investors worldwide. When reality hit, panic spread like wildfire, freezing credit and causing economic standstills. Now, let's journey halfway around the world to Japan in the 1990s. Known as the Lost Decade, Japan experienced an asset price bubble burst. Real estate and stock market prices had soared throughout the 1980s. Sound familiar? When the bubble burst, trillions of yen vanished. Japan's economy stagnated for years, a cautionary tale of speculation and over-optimism. These crises remind us of the cyclical nature of markets and the human tendency to repeat past mistakes. Ready for more insights into these intriguing events? Stay tuned as we dive even deeper into these historical financial upheavals. Let's revisit the fallout of Japan's lost decade. As real estate and stock values plummeted, Japanese banks found themselves holding massive amounts of bad loans. Without credit, businesses struggled, leading to what economists call a liquidity trap. Despite drastic monetary policies, consumer confidence was shattered, resulting in prolonged economic stagnation. Meanwhile, let's talk about a legendary market collapse that set a stage for modern economics, the South Sea Bubble of 1720. Although a little outside the 200-year range, its impact resonates strongly. The South Sea Company promised vast wealth from trade rights in South America. Investors blindly bought shares, driving prices sky high. But soon the reality dawned. Profits from trade were grossly exaggerated. When the bubble burst, fortunes were lost overnight, dragging Europe into financial disarray. Across these tales, a common theme emerges. Excessive speculation combined with lack of transparency spells disaster. From the rampant banking failures of the 1800s to the unchecked derivatives in 2008, one thing is certain. History has taught us that vigilant oversight and regulation are crucial. What vital lessons do these past crashes hold for our future? Perhaps it's that while markets might crash, human resilience and adaptability keep innovation alive. Stick around to understand how we can navigate future financial storms more wisely. These historical shocks highlight a universal truth. Financial literacy and vigilance are indispensable. Each crisis unraveled quickly when confidence faltered, showing how vital it is for investors to understand what they're putting their money into. For instance, in 2008, many investors had little knowledge of the complex financial derivatives fueling the housing bubble. The complex jargon and opaque practices kept many in the dark, exacerbating the crisis when the bubble burst. Contrast this with the dot-com bubble of the late 1990s. Fueled by excitement around the internet's potential, investors flocked to tech startups, often with scant business plans. Stock prices soared until, inevitably, reality set in, reminding everyone that sustainable models matter more than mere speculative frenzy. Companies vanished overnight, but from the rubble emerged tech giants, now household names, who had sustainable strategies and genuine innovation at their core. Reflecting on these cycles, it's clear, while chasing high returns is tempting, understanding the underlying value is crucial. Investors today have more tools and resources than ever before. With technology and information more accessible, we can make informed decisions to mitigate risks. What lies on the horizon? How can we leverage our knowledge to prevent repeating the same mistakes? Let's keep delving into these lessons and more, ensuring we're better equipped for the financial adventures yet to come. As we navigate the landscape forged by past financial upheavals, it's essential to focus on proactive strategies rather than reactive ones. The lessons from history are clear. Resilience stems from robust planning, diversification, and adaptability. Consider how the tech world learned from the dot-com bubble. Today's successful tech companies emphasize clear revenue streams and sustainable growth. They're not just about innovation, but also about solid business foundations. For individual investors, the takeaway is clear. Diversification isn't just wise, it's vital. By spreading investments across various sectors and geographies, one can cushion against the ebbs and flows of specific market downturns. Regulation often emerges as another crucial guardian against catastrophic failures. Post-2008, financial systems underwent significant reforms. Stress tests, heightened transparency, and stricter capital requirements aimed to deter reckless behaviors that once ran rampant. These measures, though sometimes controversial, underscore the importance of oversight in maintaining market stability. Moreover, financial education is more accessible now than ever before. From online courses to dedicated financial advisors, the resources to make informed financial choices are literally at our fingertips. Embracing this wealth of information allows us to craft strategies that are not only about wealth accumulation, but also about preservation. As we ponder what's next, remember that while financial storms will inevitably arise, being prepared makes all the difference. Stay informed, stay diversified, and never stop learning. These are our best tools against any future crash. Reflecting on the tapestry of financial turmoil over the past 2 centuries, one truth stands resilient. The storms of today fuel the innovations of tomorrow. Every crash we've explored not only reshaped economies, but also deepened our understanding of market dynamics, the critical nature of regulation, and the undying human spirit for advancement and recovery. So, what does this mean for you? Be proactive, stay informed, and foster a mindset of continuous learning. The more we embrace these lessons, the more prepared we are for whatever the financial future holds. And speaking of preparation, don't forget to subscribe. Joining our community means access to invaluable insights and strategies that can help safeguard your financial journey. Remember, knowledge isn't just power, it's financial security. Hit that subscribe button and ring the bell to stay ahead of the curve. Let's continue navigating the fascinating world of finance, so you're always ready for the next big opportunity or challenge. Stay curious and stay prepared.